Welcome to the Daily Drawdown, where AI, markets, and policy collide in real time. A possible government stake in OpenAI, a power grid straining under heat and data center demand, and a jobs report that moved markets while raising more questions than answers. The common thread is simple. Capital is rushing ahead, and the systems underneath it are starting to show stress. OpenAI has reportedly discussed giving the U.S. government roughly a 5% equity stake, partly to share AI upside with citizens and partly to build political cover ahead of a possible 2027 IPO. The bullish case is an Alaska-style model, where AI wealth feeds some kind of public dividend or sovereign-style pool. The risk is obvious. Once the regulator may also be an owner, every future policy decision gets harder to separate from financial interest. If that door opens, it would not stay unique to OpenAI. The real precedent would be whether other major AI firms feel pressure to offer similar structures just to stay politically aligned. The core AI debate is still supply versus economics. Industry leaders expect enormous compute demand, and some compare today's build-out to 1990s fiber, where overbuilding looked foolish until usage caught up. At the same time, there is a serious case that efficiency gains could improve costs by 10 to 100 times, which would change the value of a lot of current capacity plans. That matters because token economics are still tough for large models. Many enterprise jobs do not need top-tier hardware, and any real oversupply would hit pricing fast. Meta reportedly selling excess capacity is the kind of signal to watch. If more excess compute shows up, hardware margins and the AI infrastructure trade start looking a lot less one way. NVIDIA is also pushing beyond simple chip sales, using equity deals, revenue sharing, and outside capital to widen startup access to compute and lock in the ecosystem. Supporters see that as smart market making. Critics see something closer to claim selling, where demand can look healthier than it really is because payment is shifting away from cash. That concern gets sharper when paired with reports of huge AI cash burn and redemption pressure in tech-focused funds. The practical risk is that the AI build-out is now tied not just to public equities, but to private credit, developer financing, and data center debt. If hyperscaler CapEx slows, the pain would not stay contained to one sector. That financing story runs straight into power. The recent heatwave pushed PJM and New York demand toward extreme peaks, with day-ahead power prices jumping from about $44 per megawatt hour to $436, and one-hour spikes topping $1,1200. Grid operators are leaning on marginal generators that rarely run except in stress periods, and those assets collect huge rents when they do. For consumers, that means bigger bills. For AI infrastructure, it means power is becoming as critical as chips. That is why hyperscalers and operators are moving toward bring-your-own-power models, and why even offshore floating data centers are getting attention as alternatives to grid-constrained sites. Watch concentration risk here, too. When a company discloses multi-gigawatt capacity being built for a single customer, the credit question is no longer theoretical. June payrolls came in weak at about 57,000 against expectations near 115,000, but unemployment still fell to roughly 4.2%. That combination raised immediate doubts about the data, especially with large gaps between payroll and household surveys and a reported labor force drop in the hundreds of thousands. Low response rates and odd participation changes only added to the skepticism, but markets still had to price it and rate expectations shifted quickly. The policy split is straightforward. One camp says AI-driven productivity means the economy can handle lower rates without reigniting inflation. The other says the Fed still has to defend the 2% target, and less guidance from Chair Kevin Warsh could mean more market volatility even without a hike. The next thing to watch is whether softer labor prints keep showing up in cleaner data, or whether this report gets revised into something more ordinary. Under the surface, the market has been trying to broaden out from a very concentrated mega-cap leadership regime. There are signs that rotation is finally real, with money moving into industrials, healthcare, financials, and small-cap value, while correlation across stocks has dropped sharply and intraday sector swings have become more violent. That broader tape matters because it changes what bad news can do. In a narrow market, one group carries everything. In a rotating market, leadership can change fast and sell-offs can travel in unusual ways. You saw that in memory. The Roundhill DRAM ETF dropped about 9% in a day. Micron and others swung hard, and the market suddenly repriced a rally that had been built on scarcity and margin optimism. Oversupply fears, momentum unwind, and concern that Apple may source from Chinese DRAM makers all hit at once. The bigger message is that semiconductor margins have been unusually strong, and markets are starting to ask how durable those profit peaks really are if capacity expands and pricing power fades. Apple is reportedly preparing a foldable iPhone for early 2027 and newer models that may require substantially more memory, which makes supply security more important. Reports that Apple is negotiating with Chinese DRAM suppliers, including firms tied to U.S. security concerns, turn a procurement story into a geopolitical one. That matters beyond Apple. It shows how quickly commercial sourcing, export controls, and national security policy now overlap in both chips and biotech. Tesla delivered roughly 480,000 vehicles in the second quarter, far ahead of consensus, and that was enough to push full-year delivery expectations higher. The beat points to stronger demand than bears expected, especially across China and Europe, and energy storage deployments were also a bright spot. But the open question has not changed. Investors still want to know whether delivery strength turns into durable earnings power at current valuation levels. That question sits inside a tougher consumer backdrop anyway. Core inflation is still running hot enough to squeeze lower income spending power, and even basics like beef have moved sharply higher as cattle supply stays tight. If households keep absorbing higher food and living costs, discretionary demand gets harder to trust across the board. Robinhood is pushing tokenized U.S. stock exposure globally, expanding crypto and derivatives, and it has also become broker trustee for a program funding $1,000 investment accounts for children born between 2025 and 2028. The pitch is broader access to productive assets and a tighter link between digital rails and traditional finance. That lands in the same policy neighborhood as the OpenAI stake idea and the recurring UBI debate around AI displacement. The underlying question is who gets the upside if AI drives extraordinary wealth creation while also threatening labor demand? Economists keep warning about a narrow corridor here. If AI underdelivers, high-valuation assets get hit. If it overdelivers too fast, automation can weaken wages, demand, and macro stability. Either way, distribution policy stops being a side conversation. One story outside the daily tape is still worth your attention because it cuts across innovation and policy. John Crowley's path from pharma executive to founder after his children were diagnosed with Pompe disease is a reminder of how much U.S. drug development depends on small companies translating academic science. He built that company through aggressive self-education, outreach, and unusually scrappy financing before selling to Genzyme, which helped scale therapy access. His broader warning is current. Most new medicines begin in academia, and the startup pipeline that turns those discoveries into treatments can be weakened by slow regulation, high capital costs, and bad policy design. He also ties that directly to China. In both biotech and semiconductors, U.S. leadership is no longer something you can assume survives on momentum alone. That is the key setup right now. AI expansion is running into politics, power limits, financing risk, and harder questions about who captures the gains. You are listening to the Daily Drawdown. I'll be back with the next brief. This episode was generated by Podkey. Create your own at podkey.fm.